Trading gold is hard, not because the market is complicated, but because of how you've been taught. The market itself is simple. It's the interpretation that's broken. You've been given the pieces, but you've never had a complete system. You know the concept. You probably know more than most traders, but there's no structure telling you when to actually act. You're not new. You've put in the time, hours on the charts, videos, studying, but when it comes to execution, you hesitate, you second guess everything. Or you finally take the trade and it immediately goes against you and then runs exactly what you thought. Okay? Now, if we look at this trade here, this is one of my most favorite patterns. You have these two up candles preceding this down move that takes out liquidity. Then you have this move up that goes through those up candles, which is important, and creates a bullish fair value gap. Okay? This set of up candles is what's known as an RCT breaker. And this gap, as you know, is a bullish fair value gap, and we are coming down into that bullish fair value gap and this order block and this breaker, these two up candles. All of that is happening at what time? 10 a.m. If you look at all my public YouTube videos, I mention 10 a.m. all the time. Okay? Now, there's two things I want you to pay very close attention to. Notice that this yellow box is the New York session, and we've come down, but the market has left the low of the New York session intact. That's important. Okay? So we've come down. Yes, we've taken liquidity, but we've left a very key liquidity pool intact. This is the low of the current session that we are in, but that's okay. We have a valid setup. We have bullish signatures. We have a breaker. We have a bullish fair value gap, and this down candle is our order block. These two down candles are coming down into those three bullish signatures that I've mentioned. Okay, and that is all happening at the right time. I love setups in this first 15 minutes of 10 a.m. And that is a perfect entry targeting the high of the New York session. And that's a great move. That move is close to 200 pips. If we entered on these two down candles into the breaker, into the order block, into the bullish fair value gap, exited at the high of the session, that's almost 200 pips. Now, I didn't take this trade. Myself and my students, we were looking for shorts. And my actual trade, which I've documented here for students and created a video walkthrough for them, was this trade, over 1,000 pips, short, added to shorts, covered, taken partials, and closed close to the ultimate target, which is the previous weekly low. That was my trade. Okay? And this was some of the guidance. This is just a snippet of the weekly analysis video provided. And this was a sweep, in my opinion. I think we go lower today, back down at least to the low of New York. And then I'm expecting us to continue lower. So that's what I'm looking for. I'm looking for shorts this week as well. Okay. And that's exactly what we got. That was the trade all the way down. So while this was a good trade at the right time, this was taking traders in the wrong direction. Now, retail traders don't take their profits. They think this is going to go higher, and so they leave the trade on. So if you were of the same opinion as I, and you were looking for shorts, then what I like to do is wait for a bullish signature to fail. Now, there's a couple of entry points here. If we were looking to go short, as I said, I did not trade the New York short session. I was short for the entire day from Asia. First short here, second short here, covered partials, and then ultimately closed under the daily low. Okay, but if you were looking for shorts in New York, which is one of my favorite sessions to trade, my strategy is to wait for a bullish signature to fail. Here is a bullish fair value gap that we could wait for the market to come back down and push up into these up candles to then take a short position. We also have a new bearish fair value gap, push up into there to go lower. We can also look to see this bullish fair value gap as we close this bullish fair value gap. That's a failed bullish signature, and you push up into these up candles will be a short. Okay, but it's a lot easier than that. We can also use high time frames. If we look at a 4-hourly time frame, then it becomes easier because the high time frames make it a lot clearer. So let's look at this 4-hourly chart, and we can see let's just clean this up a little bit, a bearish fair value gap, the only bearish fair value gap, okay, on this chart. And what do we see? Look at the time down the bottom there. 10 a.m. comes up into that bearish fair value gap. We already know the targets where this move started. Okay, so don't make your trading difficult. Even when you jump down to lower time frames, you need to know where your setup may form. So now, just mind some of the other markings on the chart. Focus on this level here, around 45.80, right? So this is the 40-hourly chart. We've marked a key point of interest. So now we know we can expect a setup to form around that zone. The rest is time. If we jump down to a 1-minute time frame, we go to the New York session, we look for time, and That's our key point of interest. We see this is that manipulation. Nothing wrong with trading that setup, so long as you take profits at key levels, such as session high or back into the 4 hourly bearish fair value gap. This is a perfect long setup. And if you were smart, you would take a picture of this. And this is all you would look for, because these occur all the time. Maybe not every single day, but multiple times in a week. And if you take a picture of this and you stick it up where your computer is, and you look just for that pattern, the entry, where you have a breaker, you have a order block, you have liquidity swept, you have new bullish fair value gaps forming and a pullback into those bullish signatures, then you have a nice setup with a clear target. But the real trade is to the downside from the higher time frame signature. As I said, on that 4 hourly time frame, there is only one bearish fair value gap right there. And so that's all we're waiting for. Our bias is to the downside based on high time frame, weekly time frame, daily time frame, which I've already gone through with my students in the weekly analysis video, which they get every single week. So if we know our bias from a high time frame, we know where the setup should form, then all we're waiting for is time and the right day. And what I want to do is I am going to teach you exactly how to do this for absolutely free. And I'm doing a live stream lesson over the weekend, and I'm only making it available to 5 people. That's it. Because I want to protect the secrets, and I don't want to piss off my VIP who are now paying thousands of dollars to get access to the information. This video is being watched by hundreds of people on my YouTube channel. There's over 1,000 subscribers. I'm going to invite all of you to register, as well as all those on my Twitter account, on X, 600 of you, and 1,000 on my email list. But I'm only going to allow 5 people access for free to the lesson that I'm going to be live streaming over the weekend. So if you want to learn more about this stuff, click on the link in the description of this video and register to secure your spot on my free live lesson that I'm going to be doing over the weekend. Once I get 5 people registered, that's it. I may allow a few more to register just to make sure that I get 5 show up, but I'm only going to make this available to 5 people. It's a free lesson, live streamed on the weekend. Register now. Don't miss this opportunity.